In Nigeria, President Bola Tinubu has proposed a national credit guarantee company which aims to address the critical funding gap for small businesses, which are vital to the nation's economy. Many small businesses struggle to access credit due to a lack of collateral, with banks unwilling to lend and informal lenders charging high interest rates. The NCGC would act as a guarantor, helping businesses secure loans by providing the collateral they need. This initiative, which targets Nigeria's $160 billion MSME credit gap, is expected to boost job creation, productivity and innovation by unlocking economic potential, according to experts at the International Finance Corporation. For more on this, I'm joined by Basil Abia, co-founder Veriv Africa. Thank you, Basil, for joining me today.
Good morning, Perpetua. A pleasure to be on Business Edge this morning.
It's always a pleasure to have you. Now, speaking of having a national credit guarantee company, I would like you to speak to us about how this sort of differs from the existing credit guarantee companies that we already have in the system, whether it is the one for the government, because we know that there are some agencies of government that have their credit guarantee companies, and we also have private, credit guarantee companies. So why are we having this one? What's the difference? What is it offering that's different from what DBNs or Nexims or NERSALs is offering?
Yeah, this is a PPP arrangement, mostly private sector led by creditors, especially financial institutions that come together, of course, with the federal government leading in that regard, and certain state-based financial institutions to provide risk-sharing instruments to financial institutions who are bringing in liquidity. And by this, I mean that because the government wants to ensure an extension of credit, especially to certain sectors that are hitherto seen as high risk. So, for instance, MSMEs, as you mentioned, MSMEs have a huge financing gap, especially due to the fact that lending to them is really risky, deemed risky by the financial institutions. So this credit guarantee system has a mechanism where they're sharing the risks via the instruments that they're providing, to provide guarantees so that they reduce as much losses as possible for the financial institutions that will provide credits in this arrangement. So a typical example would be that if the NCGC generally want to give credit extension to the manufacturing sector, especially small-scale manufacturers and small-scale processing companies, the financial institutions are provided guarantees of as much as 70 or 80% or even 100%, depending on the mechanism that they are highlighted. So using a little example here, 70% or 80% guarantee means that in the adventure that there is a default by these very small processing companies, at least 70% of the default or the losses, the federal government provides financial insurance in that regard, so that the private sector players, the private financiers in these arrangements do not go with 100% loss, instead go with a 30% loss. So it's a risk-sharing instrument. And I think an example of this would be the NERSAL arrangement that the central bank provided as a vehicle. As we do know, of course, NERSAL was set up in 2011, and then in 2013, they got into the market. And by 2015, the Uncle Barbara scheme of President Muhammadu Buhari came into play. Now, what that arrangement was going to do, or what that arrangement did until, of course, it ended, the Uncle's Barbara program, as we know, ended in January 2023, or was suspended in 2023. What the arrangement did was to de-risk lending to certain value chains in the agricultural sector in Nigeria. So these value chains would have private sector players bring in the financing and liquidity, including government-based financial institutions and development financial institutions internationally. They would extend credit to value chains in the agricultural sector, and then, of course, the federal government will provide guarantees so that they don't go with all of the losses. And as we do know, of course, the report card from that Uncle Borough scheme is that there was a 76% default rate. So
absolutely. Now, let me take you on that now. That That definitely was the reason I was asking why we need, a national credit guarantee company. Number one, I want us to understand this national, credit guarantee company, is it going to be owned by the federal government? You mentioned PPP, but, who takes the higher stake? Number one. And then number two, we know that government hasn't been very good with running businesses. There is always one challenge or the other. And one of them is exactly what you've talked about, talking about the Anchor Borrowers Program. We saw it wasn't a good one at all, even though the intent was good, but maybe it wasn't well communicated, or the wrong persons were put there. I do not know. But you already talked about the over 70% default rate that we saw with that particular one. So what is the assurance that this NCG will be different from what Nassau, did with the CBN?
I think the little information that we received from all of the informationals put out there on Reuters, on Bloomberg, and on Nigerian platforms like Cable Nigeria is that this will be a major private sector-led arrangement. The federal government is only providing the financial guarantees and, of course, it's putting out the vehicle in the form of the National Credit Guarantee Company. In all honesty, I have no idea how that's going to work because we know that, of course, NESL was a private sector-led vehicle. We do know that while the central bank set up the vehicle itself, they floated a private company, so NESL became a private company, and most of the financing, all the financing was disbursed via that microfinance bank, the NESL microfinance bank. And at the end of the day, it still got that very high default rate, a 76% default rate. So it has to do with the mechanisms, the dispensation mechanisms. It also has to do with the guarantor arrangement, and most of the guarantor arrangement, we saw a lot of government actors, public sector actors get involved. I, for example, have personal experience with NERSL in the form of my best friend, wanting to access financing because he wanted to go into high-level production, food production, in livestock and in grains. While he failed to get that particular financing deal from NERSL, we know, of course, other close friends who were able to get. And the mechanisms, while they were very stringent, at the end of the day, it still brought out that 76% default rate that IMF reported on. So I think it's because there's a lot of public sector hands in terms of how the funds are spent. You will read other reports as well as the geographical distribution of the NERSL financing, and a bulk of it was skewed towards the Northwest, for instance, compared to, say, the Southeast and the South-South. So for the NCGC to not be another NERSL, they'll have to ensure that there's a lot of private sector-led risk management. Corporate governance is top tier. And then, just follow the modalities like how the Nexim Bank, for instance, or the DBN carry out most of their activities. There's little to no intrusions or interference from the federal government or any other government actors from the state governments. Because, again, another thing you have to notice, during the National Anchor Borrowers Scheme program, a lot of state governments were lobbying on behalf of their farmers and on behalf of their acolytes. So you do not want that to happen for the National Credit Guarantee Company, especially when you know that the National Guarantee Company, Credit Guarantee Company, are also going to try and make sure they reach out to certain important sectors, for instance, manufacturing sector, the renewables, and many others. So these are very important multiplier effect generating sectors of the economy. And you do not want government actors to come and influence in the dispensation, because we know how that is skewed against. So if we see private sector-led corporate governance, then there's a very high chance that the NCGC would reach out its initial goals of extending credit to hitherto high-risk sectors that really need the financing but don't get the financing because our credit infrastructure is insufficient. And then how repatriation is almost always impossible.
Absolutely. We'll come to how repatriation is almost impossible. I mean, that's a very important aspect of this conversation. But before then, I mean, we've dwelt a lot on some of the drawbacks and all of those. So talk to us about the impact this will actually have on consumers. What are the positives? Let me put it that way. And how can, consumers also key into this?
Like they say in economics, credit is the lifeblood of economic activity. So once the credit is extended to the real sector, especially the small players in the real sector, they're going to see a lot of activity, economic activity rebounding back. Production will increase. As you do know, of course, productivity in Nigeria has stalled, largely due to energy issues, but also due to structural financing issues. Structural financing issues have been almost impossible because of the very high lending rate, because of the very high inflation rate. So you do know, of course, Central Bank of Nigeria have the central authority and responsibility to rein in on inflation. And the only tool that they have in their dispensation, actually, in reining in inflation is the monetary policy rate. And in the last 1 year, they've increased monetary policy rate by at least 50% rate of increase. So with a 50% rate of increase in monetary policy rate in the last 11 to 12 months, it makes complete sense that accessing credit from financial institutions is super low. And then if you look at the data as well, only 6% of players in that who are accessing financial services from institutional financing in Nigeria, only 6% of them have access to lending services. We also have one of the lowest financing to real sector rates in Africa. As you do know, of course, our deposit to lending ratio is 50% when compared to our competitors or our peer countries like South Africa and Ghana and Kenya. South Africa, for instance, are doing a ratio, deposits to lending ratio of about 120, for instance, based on data that I've looked at. So at the end of the day, credit extension, especially to consumers and to small players in the real sector economy, will be very pivotal to the economic recharge that Nigeria needs. And so it remains to be seen the scale that the NCGC would work with. It also remains to be seen what the consumer credit corps that was set up last year, in terms of their impact, for instance. I know that current data says that they've reached out to 30,000 beneficiaries, all of them government workers, having access to certain forms of consumer credit to purchase certain consumer goods. So just from the little picture that I know, Aso Rock wants a Nigerian economy where folks can start to buy consumables using a very decent credit system, something similar to that of the US, where you don't need to pay out of pocket to buy your cars, you don't need to pay out of pocket to buy your phones, you don't need to pay out of pocket to access healthcare. Nigeria has one of the highest out-of-pocket healthcare payment, by the way, in the world, top 3, if I'm not mistaken. And that is detrimental to individual Nigerians and their health security, in that sense. Because you imagine having to go bankrupt because you want to sort out.
All right, Basil, we can go on and on. There's a lot to say, and I know, you are a policy analyst, so these are the kind of things you love to talk about. But some Nigerians will sort of want to understand how this CGC thing works. Is it that, okay, they take some percentage or they act as collateral? How does it really work? What exactly is this?
In simple terms, Perpetua, the company guarantees to a certain percentage that the financiers of this arrangement do not take 100% losses on the financing that they're providing for credit access. So I'll make a typical example. Take me, for example, as Access Bank, and I'm in the mechanism arrangement for this NCGC. Let's say I'm providing 20% of the financing for this company. Okay? If the NCGC for 2026 dispenses 100 million naira to renewable energy companies in credit access, and a crux of these beneficiaries, are high risk. Let's say maybe these are folks in the rural areas who are providing solar lamps and selling solar lamps to low-income rural dwellers, for instance, and they record a 70% loss. So let's say 100 million from Access Bank strictly to renewable energy companies who are providing the solar lamps, and there's a 70% default rate. That means Access Bank is going to lose 70 million naira. The NCGC will guarantee that at least Access Bank doesn't lose up to 70 million. Maybe max they will lose is 20 million. So they will provide 50 million in guarantee to share those risks and to share those losses.
All right. So I think
it incentivizes. Access Bank or private financial institutions like Access Bank say, look, we're not going to go into this arrangement with losses. We're still going to come out with something. And don't forget that these financial institutions will also charge per transaction. So they will
right, let me come in here. I think this is very important before we go. I mean, some of the things you talked about, that this sort of highlights the need for, a functional credit bureau ecosystem. So at the end of the day, the NCGC doesn't keep on taking on, some of these defaults. And I don't know what will happen to it at the end of the day. Let's talk about this.
Yes, there has to be a credit bureau infrastructure that is put in place. We have an ecosystem. We know that there are a number of players, both from the private sector and as well from the quasi-public sector, that are already playing that role of the credit bureau system. But it's not working because, again, identity management infrastructure hasn't been provided. There hasn't been a streamlining of that. We need to get as many adults, Nigerian adults, as possible that are put online on the identity management infrastructure. And that way you can now start to do your credit analysis and credit ratings better. When you do your credit ratings better and there's better ways of repatriation because of the credit infrastructure that has been provided, it is easier to lower the risks for certain players in certain sectors that are hitherto highlighted as high risk for lending. And in that sense, you start to reduce default rates whenever you're extending credit. You also ensure that the credit infrastructure is stronger or bolstered that way. So yeah, for me, the number one first principles thinking tool for the federal government to make the NCGC as well as the Consumer Credit Corps work is to make sure that they finalize whatever work that they're doing with the NIMC. And I know that they got in a private sector lady, top professional, by the way, to lead that arrangement. I want to see that in the next 10 months, at the very least, NIMC improves and increases the number of Nigerians that are on the identity database.
Right, Basil, we have to go in less than 1 minute. And I think it's also important to put how, being able to track credit scores is also very important. The number one is having that identity management, being able to identify people and then being able to keep track of their credit scores. Now, you've been saying a lot about the consumer credit scheme. I'd like you to give us an assessment of it so far. And if you think there is, room for improvement anyway, if you can do that in less than 30 seconds, I'll be grateful.
Yeah, there's definitely room for improvement. It has largely benefited only federal government workers, if I'm not mistaken, based on the pronouncements made by the Consumer Credit Corps Corporation last year. They have over 30,000 beneficiaries, and all of them are public sector workers, most of them from the federal government. So there's definitely room for improvement. We need to see scaling in that regard. We also need to see improvement in credit extension. To wrap it up, they have also signed an arrangement with the National Automotive Development Council, NADC, to be able to provide credit extension services to 4 indigenous automobile manufacturing companies.
Absolutely, there's a lot to say right there. I mean, it's been extended to the public also, that we also know. Thank you so much, Basil Abia, co-founder, Veriv Africa, for your insights on the show today.
Thank you, Perpetua. Pleasure to be here.